appreciate it. We know it's tough to get out in this dark fall evening, so we really love having you all here. It's nice to fill the space, and we just want to introduce you. So we've got Joanne here from Rennie and Bridget Elliott. We've got Lisa Eastwood from Eastwood Associates, and then Henry Lim, mortgage specialist from BMO. So we're going to run this tonight kind of like a panel. We've got a number of questions and some things to go over. We just want it to be really conversational. So if you have any questions throughout, please feel free to chime in, and we will try and cover all of the confusing things about first-time home buying and what that means, and pre-sale, and all the new exciting credits and bank accounts and things they expect you to have. So yeah, so great. Can you hear us okay? Do you want us to use microphones? This is okay. Okay, awesome. All right. Well, I will jump right in then. I think we're going to start with some of the questions that are the most confusing. So I'm going to start with you, Lisa. From a legal perspective, and I think everyone can chime in. I think there's a lot of angles to a lot of these things, especially the credits and things. So
I'll chime in with more questions.
Perfect. And please do as well. If parents help their child with a down payment, what are the legal differences between gifting versus loaning the money, and what level of documentation would you recommend that would be required for that sort of situation?
Yeah, I mean, I guess it's largely a question of what is the intention. Like, do the parents intend to gift the money to the children, or do they really want a loan such that it's paid back when the property is sold? I mean, it's typically a question of like, do you have other children? Have you benefited all the kids in the same way, or do you intend to? I mean, I know that the bank requires like a gifting letter, and I use the language cautiously, but you know, the gifting letter, if you're going to go ahead with the gifting letter, you should have some documentation in place, and I would strongly recommend that if there is a gifting letter, that it is a gift to that person, to your child, because if they're in a marriage-like relationship, you want to make sure that that gift isn't marital property if there's a breakdown in the relationship. So if it truly is a gift, make sure it's a gift to your child, and that that's acknowledged and not a gift to their relationship. I generally prefer some sort of loan documentation, even if the loan is forgiven down the road, because if it is a breakdown in a marital relationship, then you do have a promise, something maybe as simple as a promissory note to say, no, that this child owes the money when the house is sold. It allows for, if parents pass away, that there can sort of be a reconciliation with that debt, as compared to other children who may be beneficiaries as well. Now there may be some comment with respect to the loan aspect.
Yes, so as we see, most of the parents who are, bank of dad and mom, they are helping the kids. So the bank usually have a pro forma saying, okay, dad is giving X amount of dollars to the kids as a down payment. And usually it's non-repayment. And if it was a real loan, like a promissory note, we would have to amortize it over 25 years or 30 years, which will impact how much the borrower can borrow. But if it's a given as a gift, we don't take that into consideration. That's part of your down payment. All we need to see is that that gift fund is being deposited into the borrower's account 15 days prior to closings. And that's forgiven in a way. So we will never take that into consideration of how much they can afford. Yes, but in terms of the legal aspect of it, like what Lisa had mentioned, is what happens down the road if something does break down. Is that part of the marital asset and things like that? Yeah.
When it comes to giving a gift or a loan for a down payment, does that affect kind of the mortgage of the home in regards to receiving the first-time homebuyer benefits and things like that? Or is it only if they're on the mortgage and the title that it kind of becomes?
No, it doesn't affect it. It's title. So in terms of like the first-time home buyers, the GST or the property transfer tax, it's who's going to own the house. So the mortgage or the lender doesn't come into play at all.
Okay, it's a good segue. So why don't we touch on the GST and the property transfer tax and the first-time home buyer credit? Can you give us a bit of an overview? I'm not sure who would be the best. Maybe Henry, on kind of those credits and.
Okay, so as far as the property transfer tax, if it's a first-time home buyers, is brand new homes like Bridget and Elliott will be exempt, so you don't have to pay for it for the first-time home buyers. And as long as you live in there and you occupy it as your principal residence. If it's a rental properties, you still have to pay for it, but if it's owner occupied, you don't have to pay for it. Now, it's gonna be a bit tricky. Let's say a child is buying together with a parent, then I guess, Lisa can touch upon that. So usually to our view, this is gonna be done on proportions. So if the child owns the property 99%, and dad or mom is gonna be having that ownership 1%, then the property transfer tax will be subject to that 1% ownership. 99% will be exempt, having that child being the owner occupied properties. As far as the GST exemptions, it has been passed already, but it's not in the act, and hopefully by the time this project finishes in 2 years, all that will be rebated. And what happens is that the buyer would still have to pay for it first, and apply for the rebate later on. And in terms of the legal aspect, how that's gonna be done, I guess we'll find out in the next couple months until that act has been passed.
Okay. So, Lisa, could you touch on a little bit about your recommendations around structuring ownership when you're buying jointly with a parent, and kind of what those options are?
Yeah, I mean, typically where we see a parent on title is for mortgage purposes so that they can qualify for the mortgage. So I'll first of all comment on that path. So generally, the bank will require mom and dad, or mom or dad may need to be on title because mom or dad are also on the mortgage. Typically, we can usually see it such that the bank only requires like a 1% ownership interest, that they really are only on title just for financing purposes, but there's no true intended ownership of the property. It does create, I think we're getting this in it, but it does create problems from a probate perspective. So all of a sudden we have mom and dad, they own their home as joint tenants, they have their bank accounts joint, they have designated beneficiaries on investments, but then dad dies and it's whoops, he still owns a 1% interest in kid's home. So we're now having to probate the estate to get that 1% interest back to the children. And legal fees are about $4,000 to do so, for the whoops. So we always try and be careful. What some people do is that they actually, they will purchase the house with mom and dad, and then mom and dad will typically do some sort of like take back mortgage or promissory note. I mean, ideally, they're not on title unless there's a true investment, because we do then start to have a situation of losing out on the first-time home buyers on property transfer tax. We potentially lose out on it on the GST as well. And then we also, because it's not mom and dad's principal residence, we have an issue of capital gains too, because the full gain on the home when it's sold is exempt, but if it's not your principal residence, there's tax to be paid on that too. So you run into property transfer tax, GST, and also capital gains on the disposition as well. So ideally, we can set up an arrangement where mom or dad, unless there is supposed to be true co-ownership, mom and dad just own a very small percentage interest in the property to avoid all those other implications.
How is that interest decided? Or is that a document that's done when you're closing, to a shared document, or how is that kind of set up?
Yeah, so when we have like the Form A transfer, so when we're ready to register the purchase, it would say like 99% Lisa Eastwood, 1% John Eastwood, like as tenants in common, as compared to joint tenants, which is like Lisa and Greg own a home as joint tenants. If Lisa dies, Greg gets the whole home. So we have a divisible percentage interest that's registered at the time. And then I don't know from the perspective of your purchase whether how we can then add a parent onto the purchase contract later to finance it.
Yeah, I mean, at Bridge and Elliott, we do have opportunities for family assignment, but that's not at every property that you buy. Definitely in resale, it's not always an option right before closing, because you're working with another party and they have to agree to that, to do an addendum, to add a party, or to do an assignment.
Yeah.
Okay, so I think that probably covers most of kind of the bank of mom and dad and what that looks like.
I have one question here, being the mother. Can you not just give your child the money and then put it in their name and then don't get involved in the transaction whatsoever?
Yeah, so that would be where you're gonna gift the money, and then just a few things to think about is like, is it truly a gift? Like, is it their money? They can sell the property and
So
go
that would be.
buy another
yeah.
property. And then from a family law perspective, you wanna be careful that any spouse or future spouse doesn't try and take a run at what they believe is just the equity
Okay.
in the home. So you can gift it, you can gift tax-free, no problem. It's just, you know, do you have other children to benefit? Do we worry about a future spouse making a claim? And what if you need the money down the road? Like, do you wanna protect yourself a little bit as much as you always intend it to be a gift? Maybe it's set up as a loan with the intention that, you know, I don't have any repayment terms, no interest, nothing, but you know, if I really need it down the road, or if you get into a messy divorce, I'm gonna call on the loan just to be on the safe side.
Thank you.
Any other questions about parental loans or?
Wouldn't the lender usually want a gift letter instead of a loan?
Yeah.
We
so-
do have a pro forma, so it's provided by the bank. And all that we need is the borrowers and the parents to sign is a repayment.
Yeah, so I was talking about a divorce situation.
Oh.
If a wife or partner, another partner produces the gift letter saying, well, this was
Yeah.
a gift to both of us.
Yeah, it's used as evidence for sure, but, you know, I'm not speaking legally, but from, I guess, more from a family law perspective, everyone knows the gift letters are required for the bank, so it's really like what truly was the intention at the time, like did you intend to gift it to relationship, or did you intend just to gift it to the child? And but the gift letters are waived as evidence that no, this is a gift to us in our relationship, so you do have to be careful.
So the gift letter can be structured to just be to one person.
Well, I don't know from the bank's perspective, but in terms of like if they were to come to me apart from the bank and say, you know, I wanna gift my child $100,000 to buy a house, I would definitely say draft the gift letter for your child and not for the relationship.
Yeah, to the bank it's the same, so you're having the gift from the parents to either one person or to the couple, it's the same. It's towards the down payments of this property purchase. So to us, one name or two names, it doesn't really matters. And again, it goes back to the legal aspect and the family law, the intention of that. Yes. But just to touch upon that, Brittany was saying, because this is a first time home buyer, so usually we recommend the first home buyers talk to a bankers, you know, whoever that person is, just to find out how much this individual is qualified based on their own. If they can afford X amount, great. If they can't, seek for parents' help, you know, as a co-signer, and try to find out what their budget is and how much they can afford. And so something I just want to touch upon. If you're buying a resale homes, when you come to the bank will say, yes, you can borrow X amount of dollars. That approval is good for 130 days. And then if you buy a pre-sale like this, it's out 3 years out. And I've done files for this particular project. So what happened was that this person, her income is X amount, and because this is closing in 3 years' time, so as she progresses, the income level for say 25 is X amount, in 26, she knows that she will continue to have raise, her career is gonna progress. So as that income progresses, say from 60 to 70s, by the time it closes in say 27, her income is at 80, we can always reevaluate that, how much she can borrow. And we can revisit the file, so she could qualify for 300 today. In 2 years' time, she could be 400,000. And at that time, if parents was there on title 3 years ago, we can actually take the parents out, and then she can stand on her own. And then we can do a lot of adjustments at that time.
I have a question. What if there's two families that want to contribute, like?
That's okay, that's okay. So
Like
basically,
a young couple buying a home. One
So
family might want
each
help,
family is supporting X amount, that's fine. So that's two separate gift letters.
but one mortgage.
One mortgage, yes, yes. So from the husband is X amount from his family, X amount from her family, all that goes into the same pools. That's fine.
And just to kind of confirm one more time, so if someone is contributing a gift or a loan to a down payment, that would have no effect on the first time home buyer credit, GST or PTT, it's just if they're on title and as part of a joint
Yeah, it's who's the owner,
tenantship.
and then have they ever claimed the first time home buyer's grant before, are they gonna live in the property? And then I believe you, for PTT exemption, you have to, they send out an audit letter 12 months after you move in to make sure you're still living in the property after 12 months as well.
And there's different rules around, whether you're a first-time buyer, whether it's the PTT or the GST, how long you've lived in BC, and so it's really important to check the details for that particular tax.
Right, and I will use this opportunity to tell everyone to please grab one of these sheets on your way out. It's a first time homebuyer incentives and just kind of lists all of the GST, the new 30-year amortization, property transfer tax, first home savings account, homebuyer's plan, and all of that. Just if you don't kind of capture it all tonight, you can take this with you and it gives a good outline, but we can talk about it now as well. Maybe, Henry, could you go over just kind of the new GST rules for, or maybe just Joanne, do you want to touch on it? The new GST rules that are just newly in effect and what that looks like for first-time home buyers.
Okay, so the new GST has been proposed by the government that if you write a purchase contract after May, I think it's May 27th or 25, the GST could be exempt up to brand new homes, up to $1 million. So it's fully exempt. However, that being said, you still have to pay for it first and then apply for the rebate later. Now, as part of that GST, we will incorporate that into the purchase price. So when you borrow, say up to 80%, we'll take 80% of that GST you're paying and then incorporate that into the mortgage amount. And if it goes to 1.5, you have to pay the full GST. But if it's somewhere in between, you get partial GST rebate.
And then if you receive that rebate back, can you add it as like a balloon payment onto your mortgage, or is that?
Yes, so once you get that rebate back in Bank of Montreal, you can actually apply that as a lump sum payment. So we do allow 20% lump sum payment. So you get $50,000 back. You can always put that into your lump sum payment to reduce your amortization or reduce your monthly payments afterwards.
But even though BMO knows that they're getting that GST amount back, you still have to qualify for the full amount plus the GST.
Yes, yes.
There's no way to say, okay, that's gonna be paid back and.
No, it's to be applied afterwards.
Okay. And then whereas the property transfer tax exemption for first-time home buyers is an exemption. So you would
That's an
apply, you
exemption.
don't pay it.
You don't pay it at all. You don't pay
Okay.
it at all.
Could you go over just the rules around the PTT for first-time home buyers?
So the PTT now, if it's a brand new home, like Region Elliott, you don't pay it at all. But if it's a resale, then there is a, let me see here, I'm gonna check my cheat sheet here. It's up to 835,000 if it's a resale homes. So there is a cap to it, and then after that, you still have to pay for it. But the cash to resale homes, I think the maximum PTT rebate is up to $8,000. That's it. But again, if it's a brand new homes, you don't have to pay for it at all.
Yeah, just provided you're living in the house.
That's
Yeah,
right.
yeah.
Again, we're all talking about owner occupied, principal residence. If it's a rental, everybody has to pay for it.
And I think if you could, the last government, I think, thing we'll talk about maybe, could you touch on the new 30-year amortization and kind of that's a new thing with first-time home buyers as well?
Well, actually 30, so it all depends on the individual's financial strength. You can amortize your mortgage over 25 years or 30 years. So it's either way, it's whatever is easy on your cash flow, we can work with those amortization table for you. And then for those who do qualify for high ratios, you can borrow as much as 95% of the purchase price with 25 years or 30 years. Because in the traditional ways, high ratio mortgage is only up to 25 years, but now it has been opened up to 30 years amortization. All you have to do is pay a little bit more premiums, but if you can afford it with your monthly salaries, 30 years is a lot easier for people who are capable with minimum down payment of 5%.
And they increased, I think, the purchase price, right, to 1.5 million with 5% down?
Well, the 5% down is for anybody who is borrowing with more than 80% financing. The first 500,000 is actually 5%. Anything between 5 and 1 mil is actually 10%. So you have to work with 5% plus 10% of the remainder 500,000.
Okay.
Yeah.
Can I ask a little
Yes,
question?
Yes.
If we have a property, like it's not in a mortgage or anything, if we sell that property, can you like make some advice for us, like how to properly transfer maybe the let's say old home capital to the like new property in this tax roadmap?
So I guess to repeat, so if you do have a property under your name already, you wouldn't be considered first-time home buyers because you have
For example,
ownership already.
For example, if my family's parents under their ownership,
Right.
if they do want to sell that property and like you said, transfer the credit or money to these kind of like, let's say I'm a first purchaser,
Right.
is there any something we have to concern about during this?
So I guess you're buying the property from your parents, is that what you're referring to, or they're gonna
Yeah.
gift it to you?
Either way, yeah.
So again, Lisa, correct me if I'm wrong, but let's say if you and your parents live in the same household,
Okay.
if they gift it to you from parents to child, there is no property transfer tax. Basically, they can sell the property with $1, so there's no property transfer tax. And then because that's a resale property, there's no GST involved. So basically, you just take it over, assuming there's no mortgage to it. Anything you want?
Well, I would just say, assuming it's their principal residence, then there'd be no capital gains, but
That's right.
if it isn't their principal residence, then there'd be capital gains.
Yeah, that's right. Yeah.
I do have a question related to that. We do see a lot of parents now putting their child's name on title to benefit from, not having to do probate and that. Does that impact the child's ability to have first-time home buyer credits that we've been talking about?
Yeah, good question. So the criteria, I'm trying to remember the exact criteria, but essentially you can't be entitled to any other home in the world that was your principal residence in order to take advantage of the first-time home buyer's exemption. So if you were living at home with mom and dad and you were on title, like maybe as joint tenants for estate planning, then you lose out on the first-time home buyer's exemption essentially.
I live in a townhouse and I own it. You get advice from many different places. I've been
Yeah.
told that maybe I should bring one of my children on as a co-owner from when I pass. So how does that affect, say I put Karen on, how does that affect her as a first-time home?
Yeah, so if it's your principal residence as well, then you won't be eligible for
But
the
it's not, so.
Yeah.
I just have to wait to do that after I buy a home.
Yeah, I mean, generally, truthfully, we get this question 3 or 4 times a week, and I would say I can't, so I need to go higher numbers. It's maybe 10% of the time we actually put a child on one title to the home, because to address the point quickly, there's a bunch of negatives. So if you yourself, your home, if you defer your taxes, then you have to pay those out before you can have a child. If you have a mortgage, line of credit, or anything, that child has to be approved, or you have to get the bank's consent. If your child has a breakdown in their marital relationship, the spouse could arguably lien the property because your daughter is an owner for the purposes of the world. If there's creditors, then they could lien your property. And probably one of the toughest ones and then potentially capital gains as well, because it's not their principal residence, although we can usually deal with documents to avoid that problem, but it's still a risk. But last year the government came out and said, where we have a child on title, such that really it's a bare trust relationship, it isn't intended that the daughter is to have any ownership interest, we're just doing this for estate planning. They came out and said that a trust return has to be filed by that child every year where ownership is there. They then retracted it and didn't require the filing requirement, but in talking to accountants, if that, I think the legislation is still proposed, but I can't remember, we just don't have to file a return. So it's about $500 to file that return every year, and if the intention is that you're probably gonna sell this house maybe in 10 years, then you've wasted a lot of money to try and save on a 1.4%
So you have to pay
probate.
the deferred taxes, because I do defer my taxes.
Yeah, you have to
And
pay
that
them.
would have to be paid off
Yeah.
before I put anybody
Yeah.
else on. Okay.
So more often than not, people choose not to because there's so many risks as compared to the only benefit really is a 1.4 savings on probate if you die still owning that house.
So move to an old age home.
Yeah.
And something I know, this is maybe not so related to this event, but we did host a kind of downsizer event back in April, and Lisa mentioned a couple of options such as power of attorney and things like that, right? That can kind of help with estate planning in that regard.
Yeah, I mean, in terms of the power of attorney, that's where, like, if you lose capacity, then you have a power of attorney in place that allows someone to sell it in advance, essentially. But, you know, we have so many people coming in and trying to avoid probate on investments or house or, I mean, maybe some of you know, essentially probate is this elusive concept of, when I die, do I have certain assets that are subject to probate? So as lawyers, we don't say, oh, you have to probate. It's the banks that say, oh, you have a $50,000 bank account. We're worried about our risk. We're going to require probate on that bank account. If you own real estate in your name alone, you have to probate. The estate has to be probated because land titles won't transfer without probate being issued. If you have a car worth in excess of $25,000, the estate has to be probated. So there's these triggering assets essentially. And so sometimes it's just what it is. There's a little planning that we can do, like maybe adding a child on title, but typically we don't tend to do that until a time when maybe someone's terminally ill and we know that death is maybe imminent and there's no family law issues or creditor issues or any of those things. So thank you.
All right, I'm gonna bring it back to kind of a real world example of purchasing as a first time home buyer. I know Henry put together a bit of a case study based on like a 1-bedroom, and it's gonna be, you know, kind of, so you'll see that. They're basically like a 1-bedroom purchase price and kind of what that looks like from a first time home buyer perspective. If you wanna walk us through that.
Okay, so I don't know if everybody has one of these handy guides. It was in the front.
They're at the front, you don't really need those. We'll
It's
go
okay,
through the whole
it's
thing
just
and
some
you got it
numbers.
on the way out, yeah.
So anyway, what we have here, put up a scenario. It's a 1-bedroom at $589,000 plus GST, which is around 30,000. So with the minimum down payment of 5% that you put down, with the insurance premium, everything all added up, over 30 years amortization, your monthly payment is going to be around $27.55. That's including the insurance premium that we pay to CMHC. And then on top of that, I believe that the strata fee is around 300-ish for the 1-bedrooms. Yeah. So your ownership to this 1-bedroom condo is going to be around $27.50, plus a strata fee of $300, plus your property taxes. All in all, I'm going to say it's around $3,100. Now that's with the minimum down payment of 5%. If you were to put 20% down, then your monthly mortgage payment is going to be around $2,250. So $2,250 plus the strata fees, the property taxes, the ownership for having that 1-bedroom condo is going to be around $2,600 versus $3,200. So that's 20% down versus 5% down.
And if I used my first time, like my RRSP as a first time home buyer,
Yes.
would I have to be paying that every month too, paying it back, or when do we start?
So if you tap into the RSP under the first time home buyer program, right now you can withdraw up to $35,000. So let's say you take it out in 2025 this year, you don't have to pay it back until 2027. So it's actually 2 years afterwards, and you repay that without interest back to CRA during 15 years time span. So you just have to chip in a little bit every year for the next 15 years. That's how it works.
Is it 35,000 total, or is if you have two people who have RSPs, can you combine?
Yes. Yes.
And then
So
it would be 70,000?
that's right. So 35 from him, 35 from the other partners, and then you can use that for your down payment.
Plus, we can use the new first time home buyer savings
Yes,
account.
the FHSA, yes, the first one, yes, you can do that. And that was introduced actually back in 2023. So each person can contribute, again, this is for first time home buyers. Assuming you never had a property before, you can contribute $8,000 per year, up to $40,000 maximum. And then once you have that account set up, you can use that money in the next 15 years. And then I always encourage people who intend to purchase, set it up the sooner the better. Because let's say you set it up this year, 2025, you don't have to contribute the entire amount. All you need to is put $100 in, and then you can always do catch up. So you put $100 in 2025, in 26 you can go up to another 8,000 plus whatever you missed from the year before. So again, you can do up to 40,000 per this account. And then whatever you grow out of that is all tax exempt. So whether you put that into mutual funds, GICs, everything you grow out of that, there's no taxes to that. And then the beauty of this is that the more you put in here, let's say 8,000, it will actually reduce your employment income. So you save on taxes.
It works sort of like an RSP.
It's better than RSP. So again, for somebody who is brand new, for the young people, I always encourage them, there is options for you to invest in RSPs, that was the old days, and then the TFSAs, and then the FHSAs. So if you have nothing to do at the moment, like no account, set up your FHSA first. That's the first thing you should do for the young borrowers, the first time buyer. Do that first, because you get the tax benefit, and you can grow that portfolio without any tax implications. And once that's done, then you go into the RSPs. And then again, use that for the first time buyers and things like that, and then again, you're deferring taxes. After those two are all set up, then you go into the TFSAs, because you don't save any taxes. The only thing you grow out of that is, whatever you make out of that is a tax exempt, that's all. Yeah, so those are the three
What's the 5
secrets.
years that you mentioned in this
FHSAs?
Yeah.
So for somebody who intend to purchase a home, but then let's say in the next 15 years, they do not buy a home, then what do you do with this 40,000 that you have invested? You can roll that into the RSPs after 15 years, if you never buy one.
Is it, maybe the 5 years that you mentioned, is that you can put 8,000 a year for up to 5 years and then it maxes at 40,000?
That's right.
But it was
40,000.
only introduced, how many years ago?
23.
3 years?
2 years ago.
2 years ago. So at this point, the max that you could have in there is 24,000?
That's right, up to now is 24,000.
So if I was opening an account now, I
Right.
would put in 20 grand, not 8,000, because I haven't contributed for the last few years.
No, it goes by the day you set it up. So if you set it up in 2025, then this is the year you start.
So I can only do 8,000 a
You
year.
can only
from
do
the day I
1,000
start.
this year.
Oh.
And then if you do $100 this time in 2025, in 26, then you can go 8,000 plus another 79 to do the catch up. Yeah, so it's always better to start early, and you can always do catch up.
And
Yeah.
there's no, you don't lose anything doing it, because you can roll it into an RSP if you decide to never buy a home
In the next 15 years,
in the
that's
15
right.
years.
So the 5 years only really applies if you put the maximum 8,000 in every year.
That's right, so if you want to do
You
it,
could do it over 10 years if you didn't have it.
That's right.
Okay.
I mean, maximum is 8,000 per year, so if you can contribute 8,000 every single year from 2023, yes, 5 years is all you need to have that 40,000. But the beauty of that is it's tax deducted from your employment income, so that reduces your tax, so that you get a refund right away when you do your tax returns in April of every year. So you get partial refund on your tax, and then also whatever you put in there, if you can trade, things like that, it's all tax free.
And then at the end of the account, if you use the full 40,000 plus whatever you've accrued, do you have to pay that back at all, or it's just the account closes and that's free
it.
money?
It's all free money.
Mhm.
It's all free money.
But there's an age limit for this one.
The age limit for the FHSAs, there is no age limit. The only catch to it is you have to be a true first-time home buyer. So if you have properties already, you can't. You cannot.
Because you couldn't do it when you're over 70 years old, I think I read that on the internet.
Well, let's say I'm 50 and I never bought a property, yes, I can do it.
At
I can still.
70,
Age 70,
I think I saw that on the internet.
yeah, there is probably a catch to it. I will have to look into that.
Yeah,
But,
because I was looking into that myself.
okay, yes. I'll double check in the
Yeah.
second, yeah, I'll check that one. But I guess it's probably gonna function similar to the RSPs, because once you become 70 or 72, the RSP has to be converted to RIF.
Yeah.
So I guess, if somebody who never purchased at age 60 or even 70, chances for them to buy their first home could be lower, and maybe that's why their age restriction is there.
30-year amortization.
Yeah, no, Lisa, you know what? So I'm being a part of that. We actually were talking about. So if I'm 70 years old and I wish to buy my second home, third home, as long as I can service a mortgage, I can amortize it, and I could be 100 years old, I can still do it. Yeah, yeah. See, I guess the bank is looking, how is this person gonna service their mortgage once they take that mortgage out? Are they able to keep it? And then the lifestyle and everything else, yeah. Yes.
Just had a quick question about like actually using the funds that you have in your RSP and FHSA. So say like you're ready to sign and you want to put down a deposit.
Yes.
So I was reading that you need like a purchase agreement to actually be able to withdraw your FHSA or RSP funds so that they are indeed for like a first time home buyer. Is that the
RSP,
case?
yes.
RSP,
yes. Yes.
Okay.
Well, RSP and FHSA, there is actually a CRA, it's a questionnaire, I think it's 9 questions. All you have to do is go is yes, no, and then it tells you. It's just something for you to make sure that yes, you are buying it, and a lot of times you know you are buying a property before you take it out, right?
Exactly.
Yeah.
So just how to use it properly.
That's right, that's right. And you can take the money out 3 months prior to the completions, or 3 months after the completion is done, you can actually still take it out. So I guess you have 6 months of window to take the money out, before or after. Yes.
You can use that towards the deposit payment?
Yes, of course.
Yeah.
Yes, yes. Yes.
Not the down payment, the deposit payment.
Oh, good question. Like in a pre-sale, could you use it today to put your deposit down?
I have to get back to you on that one. I'm not sure, yeah. Yeah, because this is 3 years out, right?
Yes,
Yeah.
2 years.
Yeah.
Good question, I'm also curious. Okay, well, I have a couple questions just kind of for the panel. What is one piece of advice to give someone buying their first home? Or the biggest myth or misconception about the first time home buying process?
I'll start. I always say do due diligence. Like a lot of times you're buying your first home, you're typically buying a strata property because that's going to be the most affordable, so a condo or a townhome. And there's a lot of documentation available to you before you make that purchase. And it's a lot of reading, and it can be a bit overwhelming, but you can be working with a realtor, your financial advisors, your legal advisors, and really dig in and go through it. So read the bylaws, make sure you know that your dog's going to be allowed there. Read the strata budget and see, okay, does this make sense? Go through it with your realtor, go through it with your accountant and say, you know, does this budget look reasonable for what they're proposing here, or what, you know, see what, if you're buying a resale, see how the building is doing, the shape of the building, am I going to be paying for things coming up, or has a lot of the work being done already? So just really understand the product that you're buying, both from how you're going to live in it and also what it's going to cost you. I'm sure Henry and Lisa have other
Okay. So again, as the bankers, what we look for is that for the first time home buyer, usually they are younger people. So we want to make sure that they are aware of their own credit scores, because the bank is always looking for that credit. You know, how are you doing? Are you able to pay? Are you paying things on time? If you have a sloppy credit, even though you have high incomes, if that credit score isn't up to par, the bank may say, no, we're not gonna lend it to you, because even though you have good income, if you have a sloppy credit, the bank is not gonna lend. So again, we are looking for minimum 2 trades. So that could be a student loan, a couple credit cards here and there, even Rogers, you know, cell phones, Fidos, whatever it is. We need to see, yes, this person is a responsible, mature person who can handle financial, you know, the way they should be. So minimum 2 trade, credit score 680 or higher, and then stable job. So part-time income is something the bank will always consider, but if it's a part-time job, we need to see 2 years of the same part-time job. We need to see that consistencies. Full-time job, we need to see that is a full-time positions, at least past the probations, 6 months or more. Again, the better it is, the stable income is a key factor, and that's what the bank is able to determine. Here, like we said, your mortgage payment is going to be, you know, housing cost is going to be $3,000. May you afford it with all the income that you have? So credit credit and income is something else.
And your credit score, you can check yourself now, right? Like it's
Nowadays, you can
accessible
check.
to, yeah.
That's right,
Credit
that's right,
Karma.
Yeah.
that's right.
There you go.
And I think a lot of
Got it
banks will
figured out.
do, that's right, you can actually, TransUnion, Equifax, you can even pull your own credit, and I think most of the banks will offer complimentary credit scores. Yeah.
Hi. Can I
Yes.
ask a question? If, let's say I purchased this property as a first time buyer,
Mm-hmm.
like, if I want to, like, in the future resell it, is there a period that I have to watch out for? Like how many years?
Yeah, you have to hold it for, so for the property transfer tax, you need to hold it for a year essentially.
A year?
Yeah. Yeah, and they will send out an audit letter after 12 months to make sure that you're still living in the property.
Let's say this new property, right?
Yeah.
A year.
Yeah, and then there's the anti-flipping rules too, where you have to hold property for a certain period of time as well, or you lose out on your principal residence exemption.
And how about the GST rebate, and how long does it take to complete the whole rebate process?
Good question.
Good
We just
question.
don't know yet, yeah.
Yeah.
Waiting for the laws to come out on that
Yes.
still.
It might something like hidden in the TNC.
Yeah, we just don't have the detail terms yet.
We're still waiting for that, more to follow, I guess.
But it is guaranteed coming, we just don't know how or when.
Yeah.
Question, if my son has funds in an RDSP, can that be used towards a down payment? As, same as an RSP?
RDSP, that I don't know. But I guess if you have to, I'll check, and I'll try to find out if that can be used for the down payment. Yes. Yes.
And I just don't know whether, from the RDSP perspective, whether it needs to be purchased in the name of a trust or whether it is purchased in his name. I've done a couple where we've used the money from the RDSP and we bought it in the name of a trust in order to protect their disability
That was
payments.
my next question
Yeah.
actually. I didn't wanna do it with everybody, cause nobody else is gonna be interested.
Oh,
in it.
well,
So I was
it's
gonna ask
interesting.
you.
Yeah,
is it
yeah,
interesting?
yeah.
Yeah, but that is a question I have actually.
Yeah, so it
is
protects
what's the
their
best way to
disability
go about that?
payments if we buy it in the name of a trust, and then you have, of course, a trustee who can manage the property, and it just sort of prohibits them from going and selling it on their own or financing or doing anything, there's that.
Or
extra-
somebody else getting it.
Yeah, yeah,
Right.
absolutely, it's that extra level of protection for sure.
Mhm.
Mhm.
Okay.
Great, is there anything else in the panel that you think we missed, you wanna comment on, or?
I wanted to talk a little bit about working with a realtor, because I think as a first-time home buyer, that sometimes, you know, you walk into a presentation center like the one we have here, and you're like, oh, the first thing I'm gonna ask you is, do you have a realtor? And I'm like, oh, I didn't know I needed one, right? So I just wanted to explain the difference, you know, what we do as realtors. So I'm a licensed realtor with Rennie, and I'm selling the Bridge and Elliott project as a pre-sale. I also do my own resale work. But when you come in here, you know, why I ask you if you're working with a realtor or not is because I can only work for one client. And here at Bridge and Elliott, or any pre-sale that you walk into, the realtor that is there is working for the owner, right? They're working for the developer. So that's why we always ask you, do you have your own realtor? And as a new buyer, you know, it's definitely advised to come in with your own realtor that's advising you on the purchase, because anything that you share with us as realtors working for somebody else, whether you're walking into an open house or a pre-sale or anywhere where you're not represented, any information you share with us, we have a responsibility to share that back with our client, because we have a client relationship with the seller if we're selling that home and not representing you as a buyer, right? So we have, of course, a duty to act honestly and provide you with information on the property, but we can't advise you around price, we can't advise you around, you know, any terms. We're representing the seller. So any questions on that, every time you speak with an agent, they should be presenting you with these two documents when you're coming without representation. And the first one is your relationship with a real estate professional. So it outlines what realtor provides when they're working with you as a client, and what obligations we do not have when we're working with you as what we call a customer, or we have a different client, right? So can't represent in BC both sides of the transaction anymore, it's not allowed. So we represent one side. And then the second document will be provided if you come without a realtor, and it just explains, oh, sorry, I mixed this up. This is the first one. This is the second one. And it just explains not a client, know the risks. So it really outlines, any information that you share with me. Basically, I can share back with my client, who's in this case a seller. And if I was at an open house and you met me, it would again be the seller, right? So that's just some information here. These are available to you to, you're welcome to take them away too and read in more detail or chat.
And to touch on that too, you do hold a lot of power as a buyer right now, so meet realtors, interview them, it's a big purchase and you have to work well together and there's like that relationship as well, so I know everyone has a friend who has a friend that's a realtor, but I mean, make those relationships and it's a long relationship, so.
And as a buyer, you're not paying the commission, so there's no cost to hiring a realtor as a buyer.
Can I ask, I know that if I was buying a resale house, I would make an offer, probably a little bit lower than the asking price.
Yeah.
Is there any room for negotiation in resale?
I mean, definitely in a lot of pre-sales, you're seeing some great promotions and offers right now. And those are sometimes laid out really clearly and sometimes up to your realtor to kind of, find and dig through and present that offer. So that's definitely why you want to be working with an agent.
Another advantage.
For sure.
And maybe to touch then a little bit on first time home buying and pre-sale and the benefit of that.
Yeah, for sure. I mean, I think, buying in pre-sale gives you opportunity to kind of save in stages for your purchase that's coming up, right? In long pre-sales, like when we're looking at projects that are sometimes completing 4 or 5 years out, deposits are spread out. So they could be, something when you sign the offer, like a 5%, another 10%, or another 5% in a year, another 5% 6 months later. So every project will have its own deposit schedule, and it's an important thing to understand. And sometimes developers will work with you in creating a schedule that works for you as well. So something to consider. But that's a benefit to buying in pre-sale because you don't have to have all the money up front pulling from your RSP or wherever you're getting those funds from mom and dad or from your your work. If you know you have a Christmas bonus coming and there's a 5% payment due in January, then you're set up for that, right? So you can kind of work your way into kind of getting your funds in place. The other benefit is the banks have pre-appraised our building, like our partners like BMO, so they can hold your rates and hold your approval until completion here. So you don't have as much of a risk of having to requalify over that time period. So you get that stability, and it's just for planning. I think it's great, right? So okay, in 2 years' time, I'm moving into my new home. I know when I have to give notice to my landlord if I'm renting, or maybe I've got to find a roommate by that time because I'm going to get into a 2-bedroom, or I'm, my family can make changes in their home because I no longer need the basement in my parents' house or whatever it is, right? So I think those are 3 big areas, just kind of that timing and being able to save for it.
This has been really great and we've learned a lot, and I don't want to keep going on and on. We'll stick around for a little bit, and there's obviously food and drinks and conversations to be had if you want to have more private conversations with them. But does anyone have any last questions? Yeah, of course.
Can you guys talk a little bit about freehold, leasehold properties?
Yeah,
So it's
for
like
sure.
I know the concept of it, but
Yeah.
like the risks and stuff.
Yeah, so we're, I've sold in both pre-sales in leasehold and here in freehold, right? Our building here, Bridge and Elliott, is freehold development. It's really about the purchase price is the difference, right? The leasehold that we're seeing in Boston now is 99-year lease, so you're just being able to get in at, let's say, 10 to 15% below what you would pay in resale, but both areas are increasing at the same rate, right? It's not like freehold's going, the price is accelerating here and leasehold's in behind it. It's just you're starting out with less, needing less to pay.
But what's the risk on the resale? Like when you say you've been there for 30 years, so we're starting to see that now with properties that there's 60 years left on their lease, and people are gun shy to purchase because they're like, oh, if I have this for 30 years, there's only going to be 20 years left on the lease or whatever, and no one's going to qualify for a mortgage to buy my place or anything. Like, what are the risks there? Because I just keep hearing gossip, and I don't know the realities.
So every lease will have different terms. So to understand if it's, for all of us that don't work in that area. But reading it, most of the leases, everything you see here is 99 years, and they have potential terms for renewal and a structure around how that would be managed at the end. So yeah, I mean, at some point, you're gonna be on maybe a diminishing part of the curve, right? If you're up to like 80 years and there has been no talk of renewal, I expect that the leases here, they'll be renewing it prior to that time. But also you have to think the value of being on that land each year is increasing as well. So it kind of will balance it out. I mean, we are seeing sales in Staheke, which is, they're now 30 years old and they still sell them. You probably have some to add to that too.
Yeah, I mean, I find it interesting. I think that the Ladner, Tsawwassen, Delta buyers are very comfortable buying on TFN. I mean, they know the Tsawwassen First Nation. They know that their business concepts, Staheken has done very well and held its price. I find that people coming from outside the area are a little bit more nervous about buying on the lease land than people that are more local.
Yeah, everyone I talk to says don't do it.
Yeah, I
It's
wouldn't
also
have any
like-
hesitation myself, buying down there at all. I think some of the banks are a bit,
Well, I
they
guess-
don't lend as well against the
Well,
Lisa.
TFN, we're okay with that.
Yeah.
Because I mean, we lend to UBC, SFU, TFNs. We're okay, we're comfortable with it, because we have that close relationship. But like Joanne said, once that lease is nearing that expiry date, I'm pretty sure, all parties are gonna be involved, renegotiate new terms, and then that should be that.
But there are all sorts of leasehold that you may not even be aware of, like the Vancouver School Board leases properties and buildings, City of Vancouver, TFN, different First Nations groups, UBC. So yeah, I mean, it's just understanding what the lease is. I mean, here it's they're going to have homes for 10,000 people in Tsawwassen, so this is their business. I don't expect them to like suddenly shut it down, right?
Yeah, that's
But it's different everywhere you go. So again, it's just understanding what that lease is.
Right.
I had a question about CMHC. That's mortgage insurance, it's not insuring you, it's insuring the bank, right?
It's insuring the bank,
So
yes.
is there a minimum down payment you make to,
5%
be
is the
exempt
minimum.
from the insurance?
So if you make a down payment of minimum 20%, you don't have to pay for that insurance.
100%.
That's right, because with the bank back, the maximum we can lend is 80% against the home value or the appraisal value. Anything more than 80.1% has to be insured, and that's where the insurance comes in. So
And
you
then
can,
the insurance rate is,
so if it's between 80.01 up to 85, I think it's around 1.6. But if you're borrowing up to 95%, then it's 4%. And that's based on 25 years amortization. If you're gonna go with the 30 years, that was changed, implemented this year. If you're gonna do 30 years, the premium will be 4% plus another 0.2% for that additional 5 years
At the mortgage value.
at the mortgage value, yes.
I may want to ask Joanne a question about the home insurance, like what insurance in this area, what we have to concern about, like premium.
Yeah, we don't have any insurance issues here in Ladner that I'm aware of in QC. No, I mean, now the buildings that everything is kind of built to that 100-year flood level that's required, right? So, yeah, we don't have any issues. Buying into a strata saves you a lot of on insurance, right? Because part of your strata fees is going to the building insurance. They have mandatory like earthquake amounts that they have to cover as well. So all you're paying for is your insurance for your strata deductible and your insurance for your contents. And maybe your mortgage if you're.
Well, actually, for mortgage is very straightforward. All we need is a fire insurance. But again, fire insurance that covers everything. So the personal content, third parties, everything is covered. Yes.
Quick question about
Yes.
interest rates. So, if interest rates are really low right now, you said you would hold it for a while,
Yes.
but I thought that the banks could not hold it for more than 6 months. So like, this development will be ready in 2 years' time, so if interest rates really low right now, mortgage.
Yes,
If I qualified or applied,
yes.
would you hold that low interest rate now for 2 years upon closing?
So let me give you a couple scenarios. So if we were to talk about the market interest rate today, if you were to buy a resale home closing in the say 3 or 4 months, the average rate right now is about 4%, whether it's fixed or variable, it's around 4, that's the street rate. Now if we buy a project closing in 3 years time, the bank will hold a different rate. So we are gonna build a bit of a buffer in there. So that rate is not gonna be 4%, it could be say 5.5, 5.6. And that's gonna be, the bank is gonna hedge that rate at 5.6%, closing in 3 years out. Now, in 27, when this project is ready to close, if the rate for whatever reason, it goes to 8%, we will honor that rate of 5.6 to all the borrowers. Now, if the rate does remain the same at 4% or 4.5, so what we do is we will drop the rate so it's competitive at the current market rate. So instead of giving you that 5.6, if at that time the closing rate is 4.2, we'll give you the 4.2. So it's to the benefit of all the buyers and the borrowers.
And if it's lower, in like 3 years' time?
Yes, so if it's lower upon that closing, so once you have that closing notice from the developer, and we'll adjust the rate, so it's reflective of the current market rate. Where that's 3.5, we'll give you 3.5. If it's 8, we'll give you the 5.6. So the lower of the two.
So it's good practice to apply now?
It's always good to apply now. So if you have property, so again, so with our system, so if you apply now, once we have that firm approval, we will do the appraisal, we'll check everything. So once it's approved, it's done. All you have to do is wait for the 3 years out, wait for that completion date notice, and then we'll make sure all the down payment is paid, that's it. There's no more look back. We're not gonna check your files again. Unless there is gonna be a different amount, material change, for example, it was the borrower and the mom or dad, and then 3 years out, this first time home buyer is able to do everything, then we'll review the files at that time. But if everything is the same, we don't look back. And the beauty of that is, as we all facing right now, people who bought, say, during the height of COVID, it was say $800,000 for 2-bedroom condos or 1-bedroom condos in Vancouver. With the soft market that we're seeing right now, some of those appraisal values are coming a little bit shy from the purchase price. Therefore, if you do the approval now, or you come to the bank to apply today, when you purchase 3 years out, you may be suffering a little bit because you pay $800,000, the appraisal coming today is only at $750 or $720. So if you were to borrow 80%, thinking that, okay, 80% of 800 was 640, all of a sudden the value today is at 700, then you're gonna have that shortfall. Then you just have to ask, parents or somebody to help out with that gap, or gap go high ratio. That's what it is. Yeah. So it's always, once you make that purchase, come to see us. The sooner the better. And then find out.
Another thing, there's so many rumors going around. Everybody's talking about real estate. I haven't been in a pre-sale situation. How are you protected? Say you buy into the pre-sale and you're giving money to deposits. What if that project fails? How are you protected?
It's a good question. So developers have to, if they're going to use that deposit to fund their, construction, like what's happening now, they have to enter into a deposit protection contract as like insurance for your deposit. So if the building does stop tomorrow and all the 100 people leave the site and they're not moving forward, then and they don't have the money, that insurance protects you, so you would get the money back
The
through
full
that.
amount of money?
Yeah.
Okay.
Sorry,
Yeah,
one
go
more
ahead,
question,
please.
but I don't know if this is for Lisa or Henry, is, do you ever see circumstances where, a parent uses their own home as equity
Mhm.
to help their child?
Yes.
Like, I might not have 50,000 in the bank, but I have a $1 million house or something, so.
That's right. So a lot of times that, to keep things very simple, having the child to buy under their own names, and the parents want to help out. However, the cash that the parent may have, could be limited or could be all in stocks, and you don't want to liquidate that to have that realized capital gain. So what you could do is take your own properties, do a refinance. So say 100,000 is what's required, do a refinance on the properties, and then you can take the 100,000 and gift it to the child for them to buy under their own names. So that is doable. Yes.
Okay.
Mhm.
Any other questions?
I just wanted to, if you don't mind, I'll say something to that. If you were to try to pull out another $100,000 of equity, you'd also have to qualify for that, to
Yes.
be able to service it. But if you're not in a position to do that, you could do what's called reverse mortgage. Right? You wanna
Yes.
talk about that?
Yes. Yes. So we had, I have done a couple of scenario where that the parents are actually downsizing, and so they want to liquidate their big home. You know, it's just, you know, they couldn't look after it anymore, so they want to buy something smaller and live with a child. So what you can do is you can do a reverse mortgage. It's a reverse mortgage, and then with the reverse mortgage, what it is that the homeowners must be over 55, must be a principal residence, and then there's no interest payment at all until you sell or repay that mortgage back. So they say you do a reverse mortgage for 6 months or 9 months or a year, and then once the project closes, then you can move into this new home, sell the properties and then repay the mortgage back, the reverse mortgage.
Or it's a way to, like, if you were helping your child with a down payment, they could pay that interest on your reverse mortgage for you, presumably, and.
Actually, with a reverse mortgage, there is no payment. So what happened is that the interest will accumulate on the mortgage. So let's say you do $200,000 on the reverse mortgage. So, and the monthly payment is, again, for example, $2,000. So that $2,000 will accumulate month over month. Let's say if it's a year out, so that's $24,000 on compounding, monthly compounding. So you borrow 200,000, after a year or two, it could be, say, 250, but there is no payment at all. So basically, when you sell the home, and then that you will pay that reverse mortgage to the bank, and then you just move on. That's it. Yeah. So that's how one of the ways that the parents are helping the kids when they are downsizing and consolidating to a newer home, a smaller home.
But it's making a commitment to sell you are selling your house, I guess.
Yes. Yes. Yeah.
And it's typically at a higher interest rate than what you would get from a traditional bank.
It is, because again, bank would typically charge you about 4 or 5%, but a reverse mortgage, because of the risk and then what they're taking, is usually around 7 or 8%, and then independent legal advice is always required. That's right. Yeah.
But you could do it as a line of credit or a mortgage on your home.
Yes, so as long as that parents still has income, we always recommend to go and talk to a traditional bank. And one thing I always recommend is, let's say before you retire, you know, when you're near retirement age, 50-ish, when you're still making good incomes, have a line of credit set up. Even if you don't use it, set it up, because that will go a long way. Because if you don't use it, there's no cost to you. The only cost is to set it up, appraisal fees, which is a few $100s, you know, maybe $1,000 to set it up. And as long as you own that home, you can always tap into that line of credit forever. Yeah.
And for the reverse mortgage, you don't have to have the intention of selling your home.
You don't have to, but it's just like if you don't have a exit plan, that interest will scare you, because when you say the first years, 5 years down the road, you'll go, oh my God, this is quite a bit, because they do accumulate quite fast.
Great, well, thank you everybody for coming, and I sure learned a lot, thank you both.
Thank you for coming.
Thanks
Thank you.
Brittany for moderating, and please have some food, because I'm not gonna take all that home.